Hey everyone, welcome back to Corporate Decoder, the place where we pull back the curtain on the financial world and sometimes uncover a few surprises. Today we are diving deep into the latest annual report from Blueport Acquisition, Ltd, a company that is essentially a blank check to go buy another company. So before we even get to the numbers, this is a company that was just getting started in 2025. They had their big initial public offering or IPO in November of 2025, meaning they sold shares to the public to raise money with the sole purpose of finding a target company to buy. Think of it like a special company set up to buy another company. Their main goal is to find a business to merge with or acquire. They are funded by this IPO and a private placement with their sponsor. They have about 15 months to find a target company, otherwise they have to return the money to their investors. So the clock is ticking for Blueport. Let us look at the money they raised. In November 2025, they sold 5.75 million units at $10 each, bringing in a hefty $57.5 million. On top of that, they got another roughly $2 million from a private placement with their sponsor, Blueport Acquisition Corporation. So all in all, they had a little over $59 million to work with initially. Now, a big chunk of that money, $57.5 million from the IPO, went straight into a trust account. This isn't money they can just spend on anything. It is meant to be safe and sound to pay back investors if they don't find a business to acquire. They can only invest this money in very safe things like US government treasury bills. But raising all this money comes with costs. They spent about $2.4 million on underwriting fees and other offering costs. That's how they paid the investment banks and lawyers to help them go public. So what do they have left to actually operate and find a business? As of the end of 2025, they had just over $480,000 in cash outside of that trust account. This is the money they use for their day-to-day operations, like paying for office space and legal advice as they search for a target. Since they have no actual operations yet, their loss from operations is essentially the money they spent on general and administrative expenses. For the entire period from their inception in January 2025 through December 2025, their net loss was about $19,000. Most of this was from their operating expenses, but they also earned some interest income from the money in their trust account, offsetting some of that loss. Now here is where it gets a bit technical, but it is important. On their balance sheet, they list their Class A ordinary shares, which are basically the shares sold to the public. A huge number of these shares, over 5.7 million, are shown as subject to possible redemption. This is because public shareholders have the right to get their money back if the company doesn't find a business to buy. This amount is also shown as temporary equity, which is essentially a way of saying it could become a liability if those shareholders ask for their money back. Looking at the statement of operations for the period from January 2025 to the end of the year, the net loss was a pretty small $19,000. This is consistent with a company that is in its very early stages and has not yet completed its main objective of acquiring a business. The company's Class B ordinary shares are held by the sponsor and its principals. These shares typically have more voting power. The report shows the sponsor bought a large number of these shares for a very small amount of money, which is typical for SPAC sponsors getting in at a very early stage. When you look at earnings per S-Hair, it is a bit tricky because of those redeemable shares. They show a positive EPS of 46 cents for the redeemable shares, which sounds good. But remember, this is just an accounting thing because of how those shares are classified. For the non-redeemable shares, which are the ones not subject to redemption, they show a net loss per S-Hair of 30 cents. The cash flow statement shows that they used about $231,000 in operating activities. This is mostly the money they spent on setting up the company and preparing for the IPO. The investing activities section is dominated by the $57.5 million they put into the trust account, which is exactly what you expect for a SPAC after its IPO. The financing activities section shows the massive inflow of cash from selling units in the IPO and the private placement, less the fees they paid out. The notes to the financial statements provide more detail. The investments in the trust account are all held in money market funds invested in US Treasury securities. This means they are very safe but also not going to generate high returns. They also talk about how the costs of the IPO were handled. Some costs were directly tied to the shares sold to the public and others to the sponsor's shares, with a clear accounting for how these costs affect the balance sheet. This is a recurring theme. The Class A ordinary shares sold to the public are treated differently because of the redemption rights. The company recognizes that this money might have to be paid back, so it is classified differently on the balance sheet, not as permanent equity. And those rights they issued, the ones that allow holders to get a fraction of a share in the future, are considered equity by the company. This is because they are tied to the company's own stock and meet certain accounting rules for equity classification. The earnings per S-Hair calculation is complicated here because of the redeemable shares. They show a positive result for those shares being redeemed and a loss for the other shares. This is a common feature of SPAC financial reporting, where the accounting for redeemable shares can look unusual at first glance. The report also walks through the agreements they have with their sponsor and management, including administrative services and potential consulting fees. These are important to understand the ongoing costs and relationships. Looking at the management's discussion about their business strategy, it is clear that their primary focus is finding and completing a business combination. They highlight their experienced management team, their access to deal flow through their sponsor, and their understanding of public and private markets. Of course, they also clearly outline the risks they face. These include the possibility of not finding a suitable target company within their deadline, market volatility, and the general risks associated with being an early stage company. The report explicitly mentions that geopolitical events like the conflicts in Ukraine and the Middle East could impact their ability to complete a business combination. And like most SPACs, they are upfront about potential conflicts of interest. Their officers and directors have other business affiliations, and they have to make sure any opportunities are presented fairly to Blueport. They have agreements in place to try and mitigate these conflicts, but it is always something investors need to be aware of. The company has a board of directors with several independent members, which is good for governance. William Rosenstadt is the chairman and CEO, and Kullant Sander is the CFO. They emphasize that the board has independent directors and that decisions will be approved by a majority of these independent directors. Currently, no compensation is being paid to officers and directors. However, they will be reimbursed for out-of-pocket expenses. After a business combination, compensation will be determined, and any executive pay will be decided by a compensation committee made up of independent directors. The ownership section shows that the sponsor and its principals, William Rosenstadt and Roy Jiang, hold a significant portion of the company's shares. This aligns their interests with public shareholders, as their wealth is tied to the success of the business combination. They paid their auditors, Adeptus Partners LLC, about $80,000 for the audit of their financial statements. This is a standard fee for a company at this stage. The auditor's report confirms that the financial statements present fairly the company's financial position. However, they also explicitly state that there is substantial doubt about the company's ability to continue as a going concern. This is a serious warning that while the financials are accurate, the company might not be able to keep operating if they don't achieve their objective of a business combination. So what is the takeaway here for Blueport Acquisition Limited? They successfully went public and raised capital, which is step one for a SPAC. Their management team seems experienced and they have a clear strategy to find a business to acquire. The biggest risk is obviously not finding a target company in time, which would lead to liquidation and investors getting their money back, but no further gains. The financial statements are clean for an early stage company, but the going concern warning from the auditors is what you should really pay attention to. As a blank check company, their future is entirely dependent on that upcoming business combination. Alright, that is our deep dive into Blueport Acquisition Ltd's latest filing. What do you think about their chances of finding a good business to acquire? Let me know your thoughts in the comments below. If you found this breakdown useful, please give it a thumbs up and subscribe for more corporate and financial investigations. And hey, if you want to connect with other finance enthusiasts and get more exclusive content, check out our Discord community linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.